our results have been out for a number of weeks now. We really went on quite an extensive roadshow from our perspective. We normally focus kind of Sydney, Melbourne, and markets here, but in Hong Kong and for the first time up in New York, and we're pleased with the interest and clearly the change that's kind of occurred in the coverage. So I think as you highlight the result, I mean, 32% above our pro forma guidance, 67% up on a year-on-year basis, and we really want to set the 19 expectation pretty clearly. So we picked a single point guidance number for 19 to be up 25%, and we thought that's important given the number of changes that happened through the group and trying to give the analysts a pretty clear insight into what we think the business will do, and hence it's pretty easy to backward solve where that should end up from an underlying EBIT number. The other dynamic, and we reflected on it yesterday as we spoke with a banking syndicate, but through the results process, not one question on a statutory number. So if you feel compelled, please, because Richard will be eager to answer how we have an underlying number below our statutory. So I mean, our statutory number was higher, but the key drivers for us, and this is really the important factors, we've gone through this process. What were the key drivers for our performance? Really, it was the three core factors: the mining production cycle playing through, the infrastructure activity across kind of East Coast Australia, and kind of really across the whole country as it starts to pick up, and that domestic energy dynamic playing through. Those three thematics have been the real areas of focus of investment for us. The areas we're looking to put incremental capital in there, the areas that have really driven that performance in FY18, and really the areas that continue to drive us in 19. If you've got the slide deck there, I'll try and step through, because rather than go through the presentation, I'll try and take you through a few key slides that we think really exemplify some of the drivers. So this one's slide we've used, and that's 21. If you look through the bottom right-hand side, that really outlines probably a 10-year history on sales at WesTrac on an annualized basis. The yellow is capital sales, so fleet, and the black is aftermarket, that product support. A couple of interesting points to note: you can see the massive fleet deployment in 12 and 13. That was the major iron ore and coal projects basically coming on stream, and that was a big chunk. And then you've had that period of underinvestment. Even through that period, right after that fleet was deployed, you saw a pretty stable product support business, and that's played through. And it's taken a while for that market to continue to mature. But for us, FY18 was record parts volume. FY17 the same, and 16 before that was another record. Numbers we haven't seen in parts volume flow through, and we see that continuing to play through. So fleets are aging, and you can see that with the underinvestment. Fleets are really entering a pretty intensive maintenance period, and we see that continuing, and we see that being the driver of that mining production cycle. So I really think that's an important dynamic. The interesting part about our business is, unlike other, I'd say, mining services organizations, our business really plays to that production cycle. You know, through where we have fleet deployed, where our role is ultimately to provide service and support. Caterpillar has a dealer infrastructure to provide service and support. Clearly, we sell the machines, but fundamentally, the value we add is on that support side, and that's really the driver we see, which will continue to play through. Record volume of production on iron ore and coal, and that dynamic we do see continuing. That notion around behaviour, frankly, is completely logical from a customer perspective. They're in an asset sweating phase. They want their assets to work harder. They want it to work longer. The maintenance integration with us is really quite organised. So they will look for component exchange and rebuild. So we see this as a really healthy stage in the mining cycle. At some point, they'll have to reinvest in new fleet. But we don't see that coming through in FY19. We see the continued dynamic on the product support, and we see that probably coming in FY20. So that just gives a bit of perspective around what we're seeing on that mining kind of production cycle, and why we see that as a very strong thematic play through. So I think in a line item context, our parts growth was circa 25% year on year, and so it is a massive growth in demand there. we've seen the dynamic play through from a Caterpillar supply perspective as that parts supply network gets constrained, and that plays into the new build aspect. So, you've heard about long lead items come through on X factory. A lot of that's due to that aftermarket aspect being a pull on demand parts that feed both new and aftermarket. So we think this is more around an aging fleet profile as opposed to just a really booming kind of new sales environment. We do see that continuing. But for us, that is a key component to our business. If we look at the next dynamic around that is we've had margin improvement, but the interesting part about the WesTrac business, although new equipment sales are actually lower margin than the aftermarket, it's the lowest margin, obviously, as it flows through, but it's where we have operating leverage. And so if you normalize a equipment replacement cycle or equipment sales to where that black line was on 21, we think that's got an EBIT margin step up, from our perspective, should be 50 to 100 basis points step up in that alone. So our focus on operating leverage and driving that EBIT margin has been about cost efficiency and continuing to take advantage of the steps we took back 4 years ago, 3 years ago, where we really kind of focused on our cost structure and made sure our business was prepped for that market condition, and we are very focused on cost throughout. So I'm conscious that's probably a key element around the driver for the business. Coates has similarly kind of run through a pretty big year of transformation. I think that there's probably a couple of points to take away on Coates. Clearly, everyone's seen this graph and probably a lot of questions around it. It's one where it's I'd say committed, let, and projects that are underway, not projects been announced, not projects that are working through. So Badgerys Creek, Snowy Hydro 2 are not in that. So we do see this continuing to progress forward, and we've given a bit of context to the growth since 2016. The point I'd make on Coates is we are seeing a lot of growth in that efficiency flow through the business. Our top line grew at less than 10%. Our EBIT grew at double digits, and we see that playing through as we go forward. Our focus is on driving that return on capital and driving our EBIT margin even further. So we do see when this business is performing well, and we get that towards it, that margin in the 20s is more more reasonable kind of dynamic for Coates on the EBIT side. But I'm conscious because I know you've probably been through some of this, and we also want to spend some time talk about the Tellys, because that for us is a pretty important transaction. Tellys are set out for a long time. They've been part of our capital structure since actually SGH was created through that notion of Seven Network and WesTrac Holdings. It sat there, hasn't had a lot of attention. It's always traded at a discount. We've seen that as a effectively a perpetual equity structure for us. But the reality is we see that discount not getting any narrower. We see it extending when there's tax reform coming through. We see an opportunity to collapse the structure, unifying it, which ultimately we think is a benefit of ordinary shareholders. It's EPS cash accretive. We also get an opportunity to increase a free float, which we know for us has actually presented a big step in value change. So we think that the increase of free float 4.4% and really taking what is already part of our equity structure and putting it into ordinary shares is a positive for ordinary shareholders, and we think from a Tellys shareholder point of view, a chance to actually participate in the upside associated with the ordinary shareholders. So happy to talk through that and answer any question, but I'm conscious, really, you guys have probably seen some of this, so opportunity to kind of open up the Q&A if you like.
I suppose what you'll see is that the Tellys have in fact traded below par for the last 10 years. And more recently, when Shorten announced his proposed tax reform, they dropped in value from about $88 to about $80. We were approached by a number of holders around trying to provide a liquidity event. We went through the options that were available to us, and they're in fact very limited. So we've come up with a solution where we've offered effectively a total security solution, whereby all Tellys are given the right to vote and to consider whether they want to convert into ordinary shares. We did it at a fixed conversion ratio a fixed 15% premium to where they were currently trading, and we effectively split the benefit between the tellies and the ordinaries. We got an independent expert report concluding that it was in the best interest of shareholders. I note that CGI, Glass Lewis and ISS have both come out independently with reports concluding the same. So from our perspective, there is no precedent to the transaction. We've got an extraordinary general meeting on the 24th. Effectively, we're asking all Telly's holders, and I know Morgan certainly represent a number of Telly's holders, so we would ask you to engage with your clients and encourage them to vote. The way it works is, there's a number of options we've given. Ultimately, if we get 75% acceptance, and it's 75% of those that vote, so it's a very high threshold to get through. And then effectively everyone gets carried, so they all get converted. They do have a secondary option. They can elect to have a guaranteed cash out price at $88, but given that the security is trading, I suppose, above that price, we would expect the market to clear probably somewhere closer to 93, 94, where they're currently trading. In terms of current trading, I have set out the rationale, but it's probably appropriate. You guys sort of work in capital markets and a little more sophisticated than the general investor. So if you have a look at the short interest in SGH since we've announced the transaction, post results, we saw our share price sort of pop off the strength of the result and the guidance to $23. We've then seen effectively a 700% increase in tellies volume. So we've seen over 2 million tellies trade since we announced this transaction. Now, on the corresponding side of that, we've also seen the short interest grow to over 8%, which, given our free float, is actually a very significant proportion of the free float. So what has happened is, for those tellies holders who have elected that they weren't natural holders of the ordinary equity, they've ultimately elected to sell the tellies, and that there's been a number of people who've played that arbitrage. Now, why is that important for you to understand is because it means where some people may have perceived there to be a $500 million overhang in the ordinary equity, that overhang has now substantially been dealt. UBS and Credit Suisse, between the two of them, hold 40% of the tellies, so they hold a little over 2 million of the tellies. So in that context, and we've seen effectively the corresponding amount of ordinary shares have already been delivered via a short mechanism. So the tellies conversion, I think, will ultimately result in to the extent that the vote is successful, and we do expect it will be, will deliver the shorters effectively shares to cover their positions, which means the dislocation associated with the conversion has already been taken up by the market. So in that context, I suppose the key messages for us would be, to the extent that you've got clients out there who are invested in tellies who haven't thought about their options, we'd encourage you to engage with them to think. As I said, there's an expert's report which is comprehensive. CGI, Glass Lewis and ISS have both put out reports supporting it. But what we don't want to see is a disgruntled group of investors who get carried one way or another that haven't thought about it. So for us, ultimately, if they're informed, they've got the benefit of understanding, and clearly you guys have the sophistication to be able to work through the materials. We do think the current dislocation in the share price, we've traded from 23 back to sort of early 20s. I think once we get through this, off the strength of the result, a unified capital structure, because of the 4.4% increase in free float coupled with a 500 million increase in market cap, we also expect to get ASX 100 inclusion, which means that we start to open ourselves up to a number of other investors who currently are precluded from investing us. And we're looking to get Minsky inclusion as well. So again, if you have a look and have done the research around what happens to stocks when the weight of money of index inclusion, there's about $17 trillion following those indices. And ultimately, there's a weight of money that follows. So we're very, I suppose, positive around what the outlook of the stock is post the transaction. We always knew that there would be a period of 28 days of dislocation because that's what we had to go through to get it. But we're comfortable that once we get through that, the stock will probably trade more normally. And we think that equilibrium will probably be reached. But again, happy to take any questions in relation to the tellies specifically.